The United States tax code has marriage penalties, and today I'm going to tell you what they are and how they could potentially impact you. I'll also answer a question from one of my YouTube subscribers right at the end of this video. So without further ado, let's dive in. All right, guys, when I say marriage penalty, I'm specifically referring to an area of the tax code where it's actually more expensive from a tax perspective to file jointly compared to filing as a single or as a married filing separate individual. You see, many people think that it's best for married couples to file jointly in every single circumstance, but that is not the case. Here are the 5 top tax code provisions that penalize filing jointly. Number 1, top income tax rate. In most cases, the income thresholds for the tax brackets for joint filers are double what they are for single filers. Now, when the income thresholds are double for joint filers compared to separate or single filers, there is no marriage penalty. And this is because it takes twice as much income to fall into the tax bracket. However, this is not true in every case. In fact, the top tax bracket for single and separate filers in 2025 is 37% for people making over $626,350. However, it is only $751,600 for married couples filing jointly. What this means is that if you and your spouse have enough income to fall into the top tax bracket, you could actually end up paying significantly more in income taxes if you file jointly compared to unmarried couples who file as single. Now, why is this the case? Because if you filed jointly, you would fall into the 37% tax bracket if your combined income is over $751,600. However, if you were unmarried and both filed single, you would only fall into the 37% tax bracket if each of you made over $626,350. See the difference? So in other words, you and your spouse can each be taxed at the highest tax rate with significantly less income if you filed jointly. Now, let's move on. The standard deduction for couples with children. In 2025, the standard deduction for single filers is $15,000. For joint filers, it's $30,000. So for couples without children, there is no marriage penalty for the standard deduction. However, there is a marriage penalty for couples with children. This is due to the head of household status. For married couples without children, it is possible for one partner to file as a head of household and the other to file as single. The partner who files as head of household can get a standard deduction of $22,500, and the partner who files as a single can get a standard deduction of $15,000. So what this means is that if you're an unmarried couple with children, you can get a total standard deduction of $37,500 between you and your spouse. However, if you're married with children and filed jointly, you can only get a combined deduction of $30,000. Now let's talk about the net investment income tax. The net investment income tax is a 3.8% tax on certain net investment income, and it applies to people who have income above certain thresholds. Here's how it breaks down for single filers versus married filing joint filers. For single filers, the net investment income tax only kicks in if your modified adjusted gross income is above $200,000. However, if you're married and filing jointly, the NIIT kicks in at $250,000 for combined income. To understand the implications of this, let's do a simple example. Steve is in a relationship with his girlfriend Sue. They are not married and they both file as single filers. They are both high earners and they both make over $200,000 per year. In this case, because they file as single, they were able to collectively earn $400,000 in modified adjusted gross income because the net investment income tax kicked in. Their friends, on the other hand, Dave and Denise, are married and filed jointly. Dave and Denise also make more than $200,000 per year. Because they filed jointly, Dave and Denise have net investment income taxes kicking in at $250,000 of their combined income. So by not being married, Steve and Sue were able to earn an extra $150,000 of collective income without it being subject to the net investment income tax. What about SALT tax, state and local tax deductions? State and local taxes are taxes imposed by state and local governments, and these include a variety of taxes. There is a deduction for SALT taxes called the SALT deduction. This deduction allows taxpayers to deduct certain state and local taxes from their federal taxable income, which can help reduce their overall tax burden. You see, before Trump's first term, There used to be no cap on your SALT deduction. However, the Tax Cuts and Jobs Act of 2018 put a cap on the amount of money people were able to deduct from their SALT taxes, and this cap is $10,000. Here's how it relates to marriage. The $10,000 SALT deduction cap applies both to single filers and joint filers. It's $10,000 per tax return. So that means if you're married and filed jointly, you would miss out on the additional $10,000 worth of SALT deductions that you would get if both of you filed as single. Now, for many people, this is a significant amount of tax savings to miss out on. Let's talk about capital losses. Capital losses are losses that are generated throughout the buying and selling of capital assets like stocks, bonds, and real estate. The government allows single filers to deduct a maximum of $3,000 in capital losses per year. So if you get married and you file jointly, the government does not double the capital loss deduction to $6,000. Instead, it keeps it right at $3,000. This means that if you are married and you file jointly, you would miss out on that extra $3,000 you would get to deduct if you did not get married and if you are both filing as single. However, keep in mind, capital losses can still be carried forward. So if you had more capital losses than the annual limit that you were able to deduct with your filing status, you can deduct them in future years. So for example, if you lost $6,000 investing in crypto, you could get your $3,000 capital loss deduction in this year, and then the remaining $3,000 loss would fall over into next year's tax return. You would be able to deduct it in the following year. Now, why does anybody file jointly? You might be asking yourself that. I've covered some main negative sides in this video, but that doesn't mean that you shouldn't automatically file single every single year. There's still some very important benefits to filing jointly. For example, the income threshold for making IRA Roth contributions is significantly higher for married couples who file jointly compared to single filers. Also, it is more convenient to only have to file one tax return compared to having to file two tax returns every year. It's important to remember that the filing status that is best for you depends heavily on your specific circumstances. So I highly recommend that you speak with a tax professional to figure out what filing status works for both you and your spouse. One last thing to consider, however, is that if you do file jointly, you can be held responsible for any tax fraud or other tax crimes that your partner commits. So if you do not trust that your partner is being 100% honest with his or her taxes, then it can be risky to file jointly. This is one of the main things that causes many people who are married to file separately. Just imagine receiving a letter from the government that you are being prosecuted for tax crimes because it turns out your spouse did not disclose $300,000 in income that he or she hid offshore in offshore bank accounts. That would be a disaster. Now, here is a question that came in from a subscriber. I always answer questions right at the end of my YouTube videos from subscribers. This one came in from Donald MCW8318 on my How to Pay Less Taxes Using Rental Properties video. If you haven't seen that video, I highly recommend you check it out. Question was, can I use short-term rental scenario on my primary residence, or does the unit have to be an investment property? We rent 3 out of the 4 BRs in our primary residence, and I'm a W-2 while my wife is a realtor. The answer to this is you're more than welcome to rent out the other 3 units if you have a 4 unit. That makes you a landlord. Not to mention, if you're managing over those other 3 properties, you can run the short-term rental strategy if you're utilizing the property as a short-term rental for 7 days or less per customer, and you're showing the government that you materially participated. By doing so, you'll turn this investment into an active investment that can offset your active forms of income. If you have any questions about how to utilize active investments to offset active forms of income, I'd highly recommend you schedule a call by visiting the link below. And if you're somebody that does not care about saving money in taxes, you would not smash that subscribe button right now. And I know you already did. Thank you guys so much for joining me on this video. I look forward to seeing you on the next one. Cheers.